So today's cardinal lesson, we're talking about the federal estate tax and the effect of what's coming in 2026. And now I can add after the election, maybe. And just because of the Tax Cuts and Job Act 2017 went in effect in 2018, has a sunset provision, and that it goes back to the taxes the way they were in 2026. And that's the current law. But anyhow, so we're going to just go with that until Congress changes it. We're going to be talking about the estate tax exclusion, the federal estate tax, who needs to be concerned about this. And we're going to go through that, and then we're going to finish with a solution to the problem, or one of the solutions to the problem. So I want to put it to Tom, and I want Tom to share, why are we doing this today, Tom?
Yeah, I mean, we're doing this video because if you have a lot of money, you might have a problem that you don't even know about. And so we want to bring up that problem. We want to talk about it and give you one solution of how to address that. And so let me bring up the show notes. We have these at the link below our video. They're also on our website. We have the board. And then one of the things, and I'll just preview a little bit, we're going to be talking about life insurance as a way to cover some of the taxes on the estate. Here is the full illustration. We'll give you the summary when we go through the board, but if you want more details, you can go find this in the show notes here.
So what we got up here on the board is right now, or if you're watching this video in 2025, the estate exclusion amount is almost $14 million. And I'm sure that some people are going to say, well, what do you mean by that? That means if your estate is 14 million or smaller, you don't have to pay any estate taxes. But that's only if you die in 2025. But that's a known amount. It's $14 million, and that's per person. So if you and your spouse have 28 million or more than 28 million, then you got to worry about estate taxes. If you have less than that, you still need to worry about them a little bit, because to exercise both exclusion amounts, you need to do some planning. But we're doing this video now because at the beginning of 2026, under current law, the exclusion amount is going to about 7 million. So that's a result of the Tax Cuts and Jobs Act, where it's reverting back to the inflation adjusted amount of 2017. So anyhow, it's being cut in half. And that's brought up some interest amongst people that are talking to us that have substantial net worth. They have some concerns because it's not only how much money that you have now. If we're doing a lot of our planning for people in their 60s or their 50s or early 70s, it might be 30 years from now before the second one of them dies. And that's when estate taxes are paid, not at the first death of the first spouse. If things are planned properly, the estate taxes are going to happen at the second death. So again, this kicks out a lot of people. So we don't want to alienate our viewers as just kind of look and say, well, I don't have anywhere near that amount, so I don't have anything to worry about. And you're probably right, is if you don't have anywhere near that amount, you might want to stay tuned in to just kind of hear so you have some knowledge on this. But we really want to alert the people that could grow into a multi-million-dollar fortune at the end of the second death. We just want to show you some planning things that you could do now to prepare for a problem, really for the benefit of your children or the heirs of your estate. So the exclusion amount in 2025 is about 14 million. In 2026, it's going to go to 7 million down. It's going to cut in half. And just for some context here, in 2006, which is 20 years from when it's going down, it was $2 million. And when I got my CLU in 1991, and I started studying estate planning and became an estate planner, this number was 600,000. So when you had a couple that had a potential net worth of 1.2 million in the future, they were estate planning candidates, and they were this type of planning and this strategy that we're going to show you, we did a lot of that in the 90s, and we've done a lot of it, after 2000. And when then they ran it up to these big numbers, we haven't done that much of it until lately when this number's going down. So I just want to give you a little context on that. Is this used to be for average well-to-do people, and then through the exclusion amounts raising, I mean, it went up and up and up and up and up with the idea that they were trying to make average well-off people, like farmers that had 3, 4 million, $5 million farm, or a small business that's family owned and operated that was worth 3, 4, 5 million. Back in the day when I became an estate planner, those businesses would shut down. Even though they're worth 2, 3 million, all their money was in their business, and they had to sell the business just to pay the estate taxes. So we could be heading back to that kind of a situation at some point in the future. So you really need to become knowledgeable about this and plan for it. Now, we also have 17 states and DC, which would be 18 governmental entities that have an estate or inheritance tax. And most of those have a much lower threshold, like $1 million or $1.5 million. So some of those states and people that live in those states, or if you're curious about that, you can give us a call, and we're familiar with all those states. And so there's some people with much smaller estates that still want to do some simple planning so that they don't face, or their heirs are not forced with paying inheritance taxes or estate taxes at the state level. And so what I want to do is bring Tom back on, and I want Tom to talk a little bit. We're just discussing the problem or the potential problem that you have.
Yeah, I mean, I think like Hans mentioned that, I mean, this limit, you look at these numbers and it is objectively is a lot of money, right? It's for people that have these high net worths that have the problem right now. But when we go back through sort of the history that Hans gave us a little bit, it has changed quite a lot over a relatively short period of time. And so who's to say that won't continue in the future? But on the flip side, go the other way, right? Start cutting down, because if you start looking at where we are from a country, from a debt standpoint, the deficits we're running, they're going to be looking for revenue anywhere they can. And an estate tax is certainly a way that they could start increasing revenues they bring in. And they can go in and legislatively do this, right? And there's nothing you can do about it. I guess you could vote, but other than that, there's really nothing you can do that. And so it's something that you need to keep an eye on, even if your net worth isn't as high as some of these numbers. But like Hans mentioned, you start putting some compound growth on these account balances for the next 20, 30 years, you will be approaching some of these, especially if they start cutting that estate exclusion into the future. So just keep an eye, be aware, make sure you know what's going on, and you sort of are tracking this. One of the other numbers that is sort of changing for 2025, and this gets updated about every year, is there is an annual amount that you can exclude, that you can gift. It's called the gift tax exclusion amount. You can gift it away to any individual person and not have to claim it on any tax return. You don't have to use up some of your lifetime exclusion, which currently is that, almost $14 million. And for 2025, that number is $19,000 per person. And that's going to be important when we get into the example of the life insurance. But you can start giving some money away now and not have to use up that total amount. And that can be certainly a good way to start transitioning some of the assets out of your estate into someone else without having to pay any taxes on it. So I don't know if you have anything to add to that, Hans.
Well, I do. And just something that, if you look at like James Gandolfini, Aretha Franklin, Prince, all of those people died without a will. And they had, in the hundreds of millions of dollars. And so, I mean, I don't know whether they're settled. They don't. All I know is that they didn't have it. They found one later for Aretha Franklin, and it was a handwritten one in her old sofa or something. So the presumption is if they didn't have a will, they certainly hadn't done estate planning. And, somebody celebrity that has $100 million and they take that off of it, you're at 86 million, and then you pay 40% estate taxes. I mean, that's the government's taken 30, $40 million of that money, just swoop, pulled right in the federal estate tax. So there's a lot of people that pay this. It's really through not paying attention to it. So I'll put it back to you, Tom.
So let's get into a little bit of the solution. So we sort of defined the problem. We've defined like what it could be coming down. It could make a lot more people subject to this. And so what can we do about it? And so this video is really about sort of one type of solution. There are certainly other things you can do. But this is the use of life insurance to really provide liquidity. It provides your kids the money to cover the tax on the estate tax. And so one of the problems that we see oftentimes, and this is really comes up with sort of small to medium-sized businesses that are individually owned. The whoever the person was, they grew it, they built it, and it's a big part of their legacy. They want to leave it to the kids. It might be in the family, and then they pass away. They haven't done this planning, and that the value of that business gets brought in under this estate tax numbers. And now the kids have to come up with money to cover that. And if there hasn't been proper planning, if they don't have the cash to do it, sometimes they're forced to sell the business, undo what the person who started the business, their whole life's work, undo it because they just needed the liquidity to cover that. And so this life insurance is a great way to provide liquidity for the money. In other words, it provides money to the heirs, to your beneficiaries, so they can pay that tax. One of the things people say that sounds great, and it's not quite as simple as that, because if I went out, or if Hans went out and bought a life insurance on themselves, and we held it on, our estates grew to these numbers, and then we passed away, the value of the death benefit of that life insurance policy. So right now we have an example of $1 million policy. That $1 million then gets added into the value of my estate, which then raises the value, and then I got to pay a lot of that back in estate taxes. And so you need to do this in a very specific way through the use of a certain type of trust, so it can keep the death benefit outside of your estate, and then have in most examples, the kids or the beneficiaries as the on that policy. So they get the money, it's not included in your estate, they can cover that tax. So let's get into the example here. So we have Joe and Alice, they're married. One of the things that we have on the board, but I don't think we've mentioned quite yet, is you have a lifetime exclusion between spouses, an unlimited amount. And so when you're gifting money between one spouse and another, there is no limit to that. So that's just something I want you to sort of keep in mind. But in this example, we have Joe and Alice. They're 67 and 58. Their estate is bumping up to these levels, right? They do have a problem from an estate tax standpoint. And so we got talking to them and started, what do we need to do here? And what we showed them, and what we have in the video, is $1 million policy. Now, in some situations, that $1 million is not going to be enough to cover all the estate tax. So there's a little bit of give and take of, how much are they willing to pay for this? How worried are they about the problem? So that, if you take $1 million and you double it, just double all the numbers, you have 2 million. So this is you can adjust this sort of for your own situation. But again, this is a joint policy. So it's a second to die life insurance policy. So it doesn't pay out until the second spouse passes away. Again, important because you have this unlimited amount that you can gift between spouses. And so when the second one passes away, you have this $1 million that goes to the kids. How it needs to be structured is you need to have what's called an ILIT, or it's an irrevocable life insurance trust. It's a very specific type of trust that owns the life insurance policy. That's how you can keep it out of your estate. And what you end up doing as the people who are setting this up for Joe and Alice in this example is they gift the premium dollars into the policy, and then that trust, into the trust, and then the trust uses that money to pay the premium on the life insurance policy. And so for a couple of this age, they're in good health. The $1 million policy, we set it up as a 10 pay. So they only have to pay for it over 10 years. After 10 years, the policy is paid up. It's $29,000 a year, give or take a couple of dollars, but $29,000 a year for 10 years, and then it's done. No more premiums there. And the reason we like structuring it that way is we don't want to set something up that has an ongoing cost. Maybe we're dealing with Joe. Let's say he passes away. Alice is in her 80s, 85, and she's looking at this big expense for the life insurance and says, why am I paying this? I'll stop that. and then that really upends the whole plan that we laid out. So what's nice about having a limited pay policy is that there is more likelihood that it's not going to get, the plan won't get upended by someone coming in later on and sort of undoing it all. But what they do is they can gift the money into the policy. They have 2 kids, and so they could give up to 19 to one kid, 19 to another, and even potentially more because both spouses can do it. So they could give a lot of money into the trust without having to worry about any taxes on the gift now. But right now, what they're going to do is gift essentially about $30,000 into the trust to cover that premium. It pays the cost, and it really provides the liquidity for the kids once they both pass to pay the estate tax. And so I'm going to turn it back to Hans, and he can add some context there. It's complicated. There are a lot of moving parts, so don't try to do this on your own, because if you miss something and you miss up one piece of it, it's not going to work. And so, Hans, why don't you add some context there?
Yeah, we just thought this would be a good example to show you the cost of $1 million of life insurance on this couple. We serve a lot of people about in this age range, and this thing is going to pay off when the second one passes away. And because Alice is 9 years younger, that might actually be her, and it might be 30, 40 years from now. But I really just want to point out is that they're going to put in a total of $290,000 into this thing to buy a guaranteed death benefit of $1 million. And if we had somebody that needed $5 million, and you could and it was a couple, you could multiply all of this by a lot. I mean, it's just you could multiply all of this by 5, and it would be $150,000 a year. And it's very easy for Joe and Alice to gift into the islet $150,000 a year because Sue is married, Rita's married, and they have some grandkids. And so by the time we do 19,000 to each, we can spread it all around and justify some very large premiums. If somebody wanted to buy $5 million worth of life insurance, second to die, and they want to keep it out of their estate. So there's an illustration of this in the show notes. I want to go over, we've really only talked about estate planning and taxes today. Those are the only 2 boxes in comprehensive estate planning, and this applies to large estates. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.